A significant amount of people have been asking me about RMDs and ways to reduce those future distributions. Now, I'm going to be going over all of that today in great detail so that by the very end of this episode, you have complete clarity on strategies to reduce your future RMDs. Now, I always want to take a big step back here, and please know if you're looking at your plan and you're going, I'm going to have significant RMDs, which are required minimum distributions in the future, you have a good problem. Now, it's certainly a problem in the sense of could you do things to make sure those get minimized and pay less future taxes? Yes. But when people are saying, oh my gosh, I'm going to have these significant RMDs, like a lot of people who reach out, well, let's just take a moment and go, there are so many people who would love to have too much money, essentially, that they have to pull from. The difference is we want to make sure as planners that you don't pay any extra amount of taxes on those dollars if you don't need to. And that's where these strategies and planning points come in. But I always like to take that second to go, okay, the fact that we're in this position, this is wonderful. It's now, can we optimize this? So that's what I'm going to be talking about today. Once again, my name is Taublieb. I am an early retirement specialist and host of the Early Retirement Podcast. I'm also a financial advisor and Vice President of Root Financial Partners. So let's hop right into today's episode, which is all about RMDs. Now, if this is the first time you're hearing about RMDs, I'd probably be surprised because you've been probably listening to this podcast for some time now. And what the RMDs always stand for, just always like to take that big step back, those are required minimum distributions, meaning that is when you are required to, whether you want to or not, you're going to have to pull funds from your pre-tax accounts, things like IRAs, things like SEP IRAs, things like 401ks. These are funds that you contributed to throughout your career. And now the government is saying, hey, you at some point are going to have to pay taxes on this, and I'm not going to let you just not pull from them forever. And so when people are going, okay, what strategies, what does this mean for the long term of my plan? Well, I always like to just use this really basic example, and then I promise to go a little deeper for you, which is first thing first, not everyone's goal should be saying, how can I minimize RMDs? For example, if you go, I want to make sure, Ari, I can spend $50,000 a year in retirement, and you can see in the future your RMDs are projected to be able to, you're going to have to take out $40,000. Well, I'll be the first person to go, hey, maybe we don't want to utilize some of these strategies I'm going to be talking about today, because now what you would be doing is you'd be paying taxes, even though in the future you could really have to take those funds anyway, and it's not as if there's excess. The time where we go, hey, should we do some of these strategies is if you go, Ari, I want to be able to live on $50,000 a year. In the future, I'm going to have to take out $100,000 a year. That's $50,000 extra I don't even need to take out. The government says I have to, and I know I'm going to be taxed at a much higher rate on those dollars. So what can I do today to minimize those future distributions? That's where the strategic planning comes in. But if we knew that in the future that we want to live off of 40,000 and today we're living on 50,000, don't think about inflation or anything like that in this basic example. Well, I would say maybe we don't have to consider RMD issues here. Yes, there will be RMDs, but too many people come to me, in my opinion, and they will say, Ari, I've heard you talk about this on a podcast or your YouTube videos, and I want to make sure I don't have to pay any RMDs. And I go, that's not really the goal. The goal is to get RMDs to a manageable level and be as tax efficient as possible. It's not about eliminating them entirely. So that's a common misconception there. Now, I'm going to go through a few different examples here just so that you can fully think through, okay, how should I think through RMDs and what strategies and planning points should I consider? So my first question is, what's the goal with all of this money? Like, why are you investing? And it's really high level, of course, but you're going, great. You want to be able to travel. You want to be able to do all these things. Wonderful. I want you to do those things. But some people will keep working and working and working, and they're going to go, all right, I'm going to have these huge RMDs in the future, and I really don't want to have to pay extra taxes on them. And I'll take a step back and go, how much longer would you work if you didn't need any more money? And they'll go, well, I know I want to retire probably in the next 1 to 2 years, but, I just, I don't really know what I'm going to do in retirement, or, I want to make sure I'm fully confident. And I've seen this where people end up working 5 more years, and they tell me they want to work 1 to 2, but they just keep working, and they're going, all right, I'm going to have this big RMD future problem. And I go, well, you're telling me you want to retire earlier. You're going to have these future RMDs, certainly, if you keep working. Financially, it's not going to hurt you. The real risk is that you could have traveled. You could have done other things that you wanted to do, more time with family or focusing on your health, whatever it is you want to do. in that you don't do it because of financial reasons. So that's the real risk that I see. So now I don't need you to take a big deep dive on this, but if I were to ask you, 20 years from now, what do you want to have happen for you to feel like you had a really fulfilling and enjoyable retirement? What comes to mind first? And you don't have to, do a super, like I said, deep dive on this, but what to you would be fulfilling? Because some people would go, you know what, I know I'm going to have these big future RMDs, but the reality is if I could minimize that by taking more trips today while I have my energy and health, and, I'm going to retire in 5 years, and maybe you've got 10 or 15 years really until you're going, hey, these RMDs are really going to get out of hand. Well, could you spend more money? I mean, that's just basic number one. That's without looking into planning points and optimization yet, which I promise we'll get into, but time with family, traveling, learning new hobbies. So I would ask someone, for example, was reducing the size of your large IRA actually anywhere near the top of what actually excites you for retirement? Now, I don't say that just to get woo-woo here, but the reason I bring that up is because when it comes to your retirement, a lot of people will say, how do I make sure I optimize this and optimize that? And sometimes we get too much into the optimization that people aren't really focusing on, okay, what's the real goal with these dollars? And that's why I have to start on that, okay, what's the real goal with all of this? As opposed to starting with the numbers and then aligning the life from there, I start with, okay, what's an ideal life to you? Then the numbers, that's easy. We can work through the financial aspects of that. So when it comes to the strategies, I'm going to start going through that now. And I've given plenty of examples on previous episodes, and I'll go over them now as well. But with RMDs, when you have to think through them, when you don't have to consider them, what I always tell people is I'm all about being patriotic, but not to the point that you're paying more in taxes than you need to. So let's assume you've saved and invested really, really well, as a lot of people have who have reached out to me, and now you have $2 million. Well, now if you have $2 million, and excuse me while I'm just breaking out my calculator and doing this on the fly with you, I'm doing a very basic example, and let's assume your RMD starts at age 73. Well, you're projected to have to take out about $76,000 or so that first year, and that increases over time. So now let's assume we don't do any planning. In the future, you have $2 million and the first RMDs in that $76,000 range, and it keeps going up and up and up. Why? Because you're investing well. Well, now all of a sudden, you're going to look at your portfolio and you're going to go, oh my gosh, I'm going to have to take out, $150,000 plus Social Security at that time. So, maybe between you and your spouse now, we've got $200,000 that's coming out. You're going, all right, that's going to increase the taxable income, and, my Social Security is going to be more taxed, and all of these things are probably going through your head right now. At least they do for me as a planner. So my job is for my clients to help them minimize those and think through how best to do so. Number one is with a strategy known as a Roth conversion, what you're doing, and you've probably heard this example before, what you're doing is you're intentionally paying taxes at a lower rate today so that you don't get stuck with a larger tax bill in the future. Now, I've done a few episodes on this, but I want to break the example now, and I've actually had a few of you send me really fun messages about cauliflower. Yes, literally the vegetable, and I've talked about this a few times, but what it's doing when you're doing a Roth conversion is you're going, I'm going to have these big future RMDs. To minimize that, I want to move money to Roth accounts because I know, Ari, I've heard your podcast, and Roth accounts are tax-free forever once you do get those dollars in the Roth account. Plus, there's no RMDs on those dollars. Now, your heirs, yes, they pay. They don't pay. There are RMDs for your heirs, just like with traditional accounts. But the difference is, as long as you're living those Roth accounts, there's no RMDs. So going back to this cauliflower example, why do I bring up this vegetable? I tell people when you do a Roth conversion, it's like eating a little bit of cauliflower today. Maybe you don't love cauliflower, but you're going to have to eat a little bit of it. And if it's done well, it can be good. Don't get me wrong. But assume that you have to just pay a little bit of taxes, like eating a little bit of cauliflower, to avoid having to eat a ton of cauliflower in the future, even when you're full. So some people make it their goal and they go, I want to make sure that, my Roth is 100%, absolutely filled up by age 73 or age 74. And they want to make sure those RMDs are just zero. That's not the goal. You could certainly avoid RMDs by doing that, but you would be paying more taxes today in the sense implementing this technique to a degree that's actually going to hurt you long term, in which case it would have been probably better if you just did nothing at all. Another strategy is you could actually defer Social Security until age 70. That won't actually help RMDs by itself, but what it will do is it will make RMDs harder because you're going to have more income from larger Social Security benefits. You're going, Ari, why on earth are we doing this? Well, the real benefit is in keeping taxable income lower before 70, you can do more of these conversions. So the idea is, can we intentionally delay collecting Social Security to allow that benefit to keep growing? But that's not even the real benefit. As you can likely see now, the real benefit is if we do go ahead and delay Social Security, we can implement more conversions because our income is lower. Let's assume we don't do this and you collect Social Security at age 62. And let's just pretend that between you and your spouse and you both collect that there's $4,000 a month. So now let's assume you're both not working, you're both 62, don't think about anything else other than that so far. And here's why I bring this super basic example up. Well, now you have $48,000 a year of income that you are realizing. And so now you're looking at, okay, what tax bracket am I in? How much of a conversion should I do? And let's just pretend you want to fill up the 12% bracket. Well, 10% bracket, these lower brackets. Well, what you're going to see is you're going to be, pretty close to filling these brackets up. And yes, there's still some conversion that you could implement that would be certainly helpful and something I often would recommend for clients. The difference is, if that income was zero, I might come back to you and go, you know what, guys, can we intentionally not collect Social Security at 62? Can we wait until 70? Because it's not going to have your income base at 48,000 all the way, and of course adjusted with inflation until RMDs begin. What it's going to do is going to keep your income at zero, which I really like because I can implement more conversions, which will lower future RMDs. So delaying Social Security can be another wonderful tactic if you're worried about RMDs in the future. QCDs is another tactic. This is known as qualified charitable distributions. You can gift up to $100,000 directly to a charity per person once you're 70 and a half or older. So for example, you say, Ari, I'm doing all this charitable giving and I want to make sure I'm just being intentional and I'm being effective with the way I'm implementing this. That's exactly when I'd say, hey, if we're doing this giving, we're going to have RMDs. These QCDs fulfill those RMDs. Well, why don't we just go ahead and actually make those distributions directly from my IRA or your 401k at this point so that you can absolutely satisfy that requirement? One of the reasons we don't just say, hey, let's take a distribution, pay taxes, and then gift it is because you're not being as effective with the gift, and it's not as effective for you because you had to pay taxes and then gift that amount. So that's a strategy there. Now, another consideration here, these are a few non-traditional that I want to throw out there, which is you could certainly keep working. So if you're saving in a 401k and you're working past 72 and you don't own more than 5% of the company, you can delay any distributions from that 401k at your current workplace until they retire. So now if you have another employer that you previously worked for and there's a 401k there, that you have to take the RMDs on. I'm only talking about the current employer. Now this doesn't apply to everyone, but it's just something good to know. So it doesn't work, once again, if you own more than 5% of the company and you can't just make your own company. I've been asked that before, which is pretty funny. Now, the last strategy I want to talk about today before talking about heirs and how RMDs impact future generations is if you have a much younger spouse, you could lower your RMDs. Here's what I mean by that. If you ask yourself, are you married? Are you at least 10 years older than your spouse? If so, you may be able to reduce your RMDs by naming your spouse as the sole beneficiary of your qualified retirement account or IRA. Most people use what's known as the IRS Uniform Lifetime Table, and that calculates their RMDs. However, if your sole beneficiary is a spouse who is more than 10 years younger than you are, you may use the joint life and last survivor expectancy. So it's a different table. By factoring in your spouse's longer life expectancy when calculating your RMD amounts, you end up with a higher life expectancy factor. What does that mean? that means that you are going to have a smaller RMD. So let's assume I'm going to take a woman and I'm going to name her Sheila. Why Sheila? Actually, I was watching The Other Guys. If any of you guys have seen that movie a few weeks ago, that's just first name that came into my head. Let's pretend Sheila is, Sheila's 70 years old. Okay, so Sheila's 70 and her new husband, her husband, let's call him John. John is, let's say, 25 years younger. Okay, so John, in this case, John's 45. So after she names John as the sole beneficiary of the IRA, well, now this allows her to utilize that joint life expectancy table. Remember the different table, which means she had a life expectancy factor of 34.7 in this example. Her RMD would be $14,409, which is the $500,000 divided by that number, 34.7. If she kept her younger husband away from her IRA, she would go ahead and calculate this RMD on her own. So she's not doing what I just talked about. She's just going with that first one I talked about, that uniform lifetime table. That would assign her her own life expectancy factor of 22.9, in which case her RMD would be about $21,800 or so dollars. So by naming her much younger husband as the sole beneficiary, she'd reduce her RMD by about $7,000. So when people are like, Ari, what's the value of this? What are the planning considerations? This is an example of that. Now, I've talked about this. In fact, I think it might be coming in an upcoming episode where I'm going to be talking about asset location. Now, this is a big one, and it's a strategy. What I just went through is a little bit more nuance, if you will. This asset location is something I can see so many people just not knowing how to implement, or they just haven't implemented it. And most people who come to me for a custom plan, they haven't actually gone through this, or they haven't heard of this before. But asset allocation is what's the amount of stocks, bonds, and cash that you have. Asset location goes of those assets, how should I own them? For example, let's assume that you determine you want a 60-40 portfolio, 60% equities, 40% fixed income. Most people will go, got it. So 60% and 40%, I got that in my head. Now let me go implement that in my Roth IRA, brokerage account, and that's asset allocation. That's not asset location done well. What I advise clients is I go, okay, if we determine 60-40 is the right balance, let's not just own that equally in an IRA, Roth IRA, and brokerage account. Let's be really intentional about this. Because what we want to do is, once again, reduce future RMDs. So let's assume that you want a 60-40 portfolio. Well, I would rather have the fixed income, the portion that's going to grow less and less over time intentionally in your IRA. I want the assets that are projected to grow as much as possible over time. I want those to be in your Roth IRA. So for a lot of clients that come to me, they're retiring early, maybe at call it 58 or 62 or something like that. Let's use the 58 example. What I'm telling them is I'm saying with your brokerage account, can we make sure that that's invested just a little bit for growth to make sure that it's certainly outpacing inflation, but we don't want to take huge risk, because what we're doing with those dollars is we want those accessible and liquid to keep income low, to do these other tax planning strategies. So because of that, when we look at planning, I'll often recommend a more conservative allocation for the brokerage account. Then I'll go to the fixed income assets and I'll go, okay, what's the right balance we should have? If we want to own assets that are fixed income, what portion should go towards, for example, our IRAs or 401ks or 403bs, assets that are pre-tax that we're going to have RMDs on in the future. And I will say, hey, what's kind of the minimum to have there? Not because I don't want your assets to grow. I do want them to grow, but I want them to grow intelligently so you pay less taxes in the future. It's cliche, but it's really not about what it is you make, it's what you keep, and that's where the asset location comes into play. Now, I want to go over the impact on heirs. So far, I've talked about RMDs, what they are, and how you can reduce them, and strategies to think through. But if you're going to have big RMDs, and God forbid you do pass away, here's what happens next. If you have IRAs in the millions, and assume it grows and grows and grows, and by the time you pass, it's now at 5 million, well, that has to get distributed to your heirs, and they don't just have their whole life to take that. There's a certain amount of time, and as of today, that has to be distributed over 10 years. So that's assuming, you're getting a good amount of growth and you pass away and it's now you have $5 million. Well, that's assuming that heir now has to take $500,000 every single year so that $5 million is fully depleted over 10 years. Now let's assume on top of that, you're getting 6% growth. So assuming 6% growth, that's $680,000 a year on that $5 million. Even if there's no other income, that alone no other income for the heirs, to be crystal clear here, that alone puts them in the top federal bracket if we're looking at today's dollars. So now you're going to be taxed, federal and state. We could be looking north of 50% on those dollars. And so most people are like, Ari, I want to avoid that. So a planning point for people with significant IRAs is sometimes I'll create a charitable trust, have that trust become the IRA beneficiary. Why would I do that? When an account owner and spouse passes away, the IRA passes to the trust. So it's not going directly to that beneficiary, not directly to the heir, for example, a son or a daughter in this case. So it's going directly to the trust. The charitable trust, then distributes a percentage of income to your beneficiary. For example, 5% to start. That's going to happen until your beneficiary passes. Then a charity receives the remainder of the balance. So the idea here is if you already have charitable giving as part of your plan and you don't want your heirs to be taxed heavily on these dollars, can you do a workaround with something like this? It's a way of extending the tax benefits even after you're gone. A few other things is, once again, RMDs, they're a byproduct of the size of your IRA. So I don't want people going out there and going, I'm going to make sure my IRA does not grow, so my RMDs are less. That's like taking the example of, I don't want to get a bonus at work because I don't want to have to pay more taxes, even if it's a net positive to you. So there are certainly strategies, as I've gone over today, to reduce this. But when it comes to RMDs and thinking through all of this, ask yourself, what are your real goals? Because most people don't come to me and go, Ari, at the end of my life, I'm going to be so excited that my rate of return, over the course of my lifetime was 7.632%. And this Roth conversion strategy allowed me to be able to pass along XYZ. No, what most people want is they want to be able to retire earlier, spend less time maybe working a job that they don't enjoy, or spend more time focusing on their health or energy while they have it, on traveling. They want to get the most out of their life, and I've seen too many people try to get the most out of their dollars as opposed to the life first. So understand, yes, tax strategy and investments and all of these, of course, they speak with one another and they play a big role here. But if you want to implement this as effectively as possible, ask yourself, what's a successful life? Then say, okay, how do the finances of all of this, how should I then make sure this is organized and implemented in an effective way that just aligns with your actual goals? So that's it for today's episode. Once again, if you're wondering how do I reduce my personal RMDs, then of course, please reach out to me and we can walk through that on an individual basis. That is, of course, one of the major things I help clients with, is to reduce future RMDs, understanding not just the investment aspect, but the tax piece, which is probably why 90% of people reach out to me. And let me actually explain all three reasons, just because I've given this example a few times, but the three main reasons people reach out. It's number one, there's not a tax planning strategy today. I have an advisor, but they're just not doing the tax piece, and they tell me go talk to my CPA, and it's just not helpful because they're not giving forward-looking advice. It's only in the past. And so tax planning. Number two, let's assume you have an advisor and they've done an amazing job. Well, if they have done an amazing job, then the reality is they are probably close to retiring themselves. And so now you might have to interview someone for the next 1, 2, 3, 4, 5 years. And I don't want you to have to do that either. And then really number three is maybe you love managing your finances, or maybe it's resonated with you up until this point. But number one, you don't want to have to do it any longer, or you want to make sure that your spouse, who oftentimes, one spouse kind of heads the financial aspect of the relationship, you want to make sure they're okay and they have someone they can speak with if they need to. So different, of course, reasons to reach out to an advisor when it does and doesn't make sense. And I keep getting a few messages on, Ari, can you do like a full breakdown on when it does make sense to work with someone, when it does not make sense? Because I've said this in previous episodes, I don't believe everyone needs to work with an advisor to be successful. I know a lot of advisors would not say that, but I just don't believe so. And I think there are certainly reasons and value to hiring an advisor, or I would not be one. However, I don't think everyone needs one. When people reach out to me, it's not because they really need me, honestly. It's because they want to make sure they're doing as good as they possibly can, and they're happy to pay for that value that comes financially. Of course, the non-financial aspects of not having to do all of these tactics and strategies I talk about in retirement. So that's it for today's episode. Hope it was helpful. If it was even remotely helpful, I kindly ask that you leave a 5-star review and just a quick note on why the podcast has resonated with you so far. Once again, thank you for listening to the episode. I'll see you next week. Thank you for listening to another episode of the Early Retirement Show. If you have a question that you want answered in a future episode, you can always go to my website, earlyretirementpodcast.com. That's earlyretirementpodcast.com, and you can go ahead and submit a question that I'll look to answer in a future episode. Thank you all for listening. Please do rate it, review it, and share it with someone who you think would benefit from this information, if there's anyone out there that you know. I certainly appreciate it, and I will see you all each week. Hey guys, it's me again. Please be smart about this. Nothing in this podcast should be construed as financial, tax, or legal advice. Consult with your tax preparer or financial advisor before taking any action. This podcast is for informational purposes only.